Hi everyone, welcome to another honeystocks.com stock market outlook video. This will be going out on Saturday the 12th of November 2022. Now before I flip over to my screen share and walk you through all of the charts and a lot of the data that I think many of you tune in for, it's been a wild week. I think we've obviously had our CPI print, we've had the collapse of a lot of the cryptocurrency names, etc. So there is a lot to digest and a lot to get through at the moment. But my work has had a lot of attention again over the last couple of weeks because of some big calls that I've made at big moments. If you don't follow me on Twitter or social media, I would encourage you to click the link in the description that will take you through. But I will be going through a deep dive of the market, the key themes, the structural trends that we're seeing. But what I would say is that a lot of the names that I will be walking through this weekend, I may hold positions on some of the stocks. Some of our clients may hold some of positions as well because there are some charts that I have already communicated with them. But as most of you know, I do not use the magical hindsight indicator. I timestamp every single piece of my work, which is very, very important for the field in which I work. Although I use technical analysis, I use it in a manner that looks under the hood of the market to find correlations, to find structural trends in the market, and of course, hopefully that can help to drive outperformance in your portfolios. I'm not looking for little 20-cent moves. I'm not looking for $1 moves. I'm in it for $10, $20, $200 moves because I understand that trends in the market are ultimately what drives out performance. But a lot of the charts I think you'll probably find a lot of value from this week. But everyone really wants to know is, has the market bottomed? Can we pile into growth tech again after some insane moves that we've seen this week? So I will be covering that as well. If you have just stumbled across my work for the very first time, some of my recent time-stamped calls, I called the market crash right at the start of the year. I called the bear market rally in June. I called the top in August. I've called the recent collapse in the dollar and a potential market bottom. And you could go all the way back to the 2020 crash where I got our clients defensive 10 days before the big event. So I am an analyst who has a decent track record for being mostly correct, which again helps in this field. But if you do get some value from my work, please do like and subscribe on YouTube. It would be hugely appreciated, and feel free to follow me on Twitter as well. Of course, please pause the video, make sure you're comfortable with this very, very important disclaimer before continuing any further. And to give myself a little bit of credibility, again, most of you know I work towards my CMT. So enough about me, let's dive into some charts. Now, with the markets, of course, this is just a brief overview of what we are currently seeing month to date. We can see that Germany, the DAX, is absolutely ripping at the moment. But what has caught my eye, I think more than most, is the performance of the equal weight S&P 500. Yes, we can look at the triple Qs and mega cap tech, etc. We've got earnings out the way. A lot of those charts are looking incredibly attractive at the moment from a risk to reward proposition perspective. But I get a lot of questions about why the US dollar is currently collapsing. Now, the reason the US dollar is incredibly important is if you pay attention to things like correlations like I do, we know that the theme all year has been US dollar index ripping higher, S&P 500 going lower. Now, I put out a tweet on the 21st of October saying the US dollar is very close to an epic collapse. Bookmark this tweet. Now, at the time, I got a lot of private messages on it from fellow professionals asking me what I was seeing. And very, very basic overview is when we start to put in lower highs. That's all I need to know, I guess, with technical analysis. But the interesting thing from my perspective is the euro, which makes up the bulk of the US dollar index. If we can see that the euro is about to break out and rip higher, then common sense tells us that the US dollar is going to drop. Now, given the correlations with the US dollar index and with the VIX, if we know that the dollar is going down, if we know the VIX is likely to follow, that's in an environment where stocks are likely to thrive, and that's exactly what we've seen. I covered these charts a few weeks ago in my last social media analysis, and for those of you that are screaming at your computers at the moment or your phones, I am fully aware of the yield curve. I know that a recession is likely to follow. Now, I did cover this chart a few weeks ago. Now, for me, 2 months consecutive of negative GDP, which we had, for me, the recession is already there. I know there's a lot of economists, etc., that will debate that. But from my perspective, I think we're probably already in a recession, but fully understand that there's other sides and more educated views than mine. What matters to me at the moment is what is going on with price. We're seeing the British pound continue to rip higher against the US dollar. Again, I made a bottom call on the pound a couple of months ago. The market is completely interconnected. Now, I am going to, of course, get into some individual stocks to add to your watch lists, etc. But it's very, very important to go over the broader market, because I think that there's many analysts, many of you that will be watching that maybe look at your S&P 500 charts and you're trying to time things on 15-minute time frames and gauge market direction. The market isn't as straightforward as that, unfortunately. It's all that there's a lot of intermarket relationships, and it's really just a case of best guess, and that's the way that I approach the markets. Now, of course, hindsight tells us that this information of dollar down, stocks up, VIX down, etc., it tells us that stocks are likely to thrive in that environment. But this chart got, again, a lot of attention a couple of weeks ago because I like to pay attention to what the bond market tells me. And when we start to see that the bond market is starting to rise while the S&P 500 is going lower, that's a divergence to pay attention to, because the bond market will quite often lead the stock market. And ultimately, this divergence, again, I covered this a few weeks ago, has ultimately started to play out, where we've had the divergence with the bond market, and of course the S&P 500 has now started to follow the bond market. The bond market is incredibly important. I covered this again in our weekly letter on the 25th of October, just highlighting that we were probably approaching a bottom in bonds, and if we get that bid in the bond market, again, that would be a risk-on environment for stocks. And what we're seeing over the course of the last few weeks is everything is just coming together, and we are seeing an almighty rip in the stock market. Completely predictable. But again, I understand that for many of you that maybe don't have the tools at your disposal like many of us professionals have, and the understanding that the stock market typically bottoms 6 months before the economy does also. So the news that you're seeing, about the economy, the market's already pricing that in, and the stock market typically bottoms, like I said, 6 months before the economy does. And of course, this is something that I like to keep on top of. We're seeing the 10-year note starting to decline rapidly, in my opinion. It is still in a long-term structural uptrend, but it is constructive. If you're wondering why growth stocks ripped, the CPI number, of course, gets all the headlines, but for me, the 10-year note has been declining. We've had the declines across the board with the dollar index, and again, we've just seen this almighty rip in stocks. Now, the big question that I'm getting at the moment is, Sam, growth or value? Now, this is going to be a little bit of an ambiguous answer, and I apologise for those of you watching, but for me, it's likely to be a bit of both. Now, we can see, now this is a chart, if you just allow me 30 seconds to break this down for you. This is a relative comparison chart dating back to the beginning of the year, which just shows the performance of a lot of the main value ETFs versus a lot of the growth ETFs. Now, my work for pretty much the whole year has been centered around value. There's been very, very few growth tech names put to our clients, and the reason for that is a lot of those stocks have incredibly high PE ratios, negative earnings growth, etc. Now, I don't see that changing anytime soon. And something that you have to bear in mind is when we come out of a bear market, we quite often see new leadership. And I think the value names could be that new leadership. Yes, we will have to navigate certain periods of time where growth tech names will rip 20-30% on a given day. You tend to find that very much happens quite a lot, especially in bear markets. I'm not saying that we're definitely out the woods of a bear market. I think that there's definitely the possibility that we are dealing with a bear market rally at the moment. But a lot of the charts are looking a lot more constructive, and a lot of the charts and a lot of the data points point to higher stock prices. We can look at the relationship between value and growth. We were hitting new 52-week highs, but what I would like to draw your attention to on this chart is what happened when we came out of the dot-com bubble. Value stocks absolutely ripped versus the growth names. Now, we are now back up above those levels from July 2000, so it's no surprise to me that we are hitting new 52-week highs in this relationship. And if we see something similar like we did in July 2000, where we see new leadership coming out of a bear market, for me, it makes sense to have a look at value names, but sprinkle in growth names here and there that make a lot of sense. We can look, of course, at the S&P 500. Now, what I would like to just point out is I don't want to be the analyst that talks about the magical hindsight indicator. So what I've done here is I've prepped some charts and added them onto my charts just to show that I'm not using the magical hindsight indicator. I have called a lot of these moves over the last month. You can go back over social media histories, etc. But I made a bottom call on the S&P 500 on the 18th of October, and we are already up 14% from the lows. Now, this is a really interesting chart to me because the S&P 500 new 6-month lows list actually peaked in September. Again, as I said, it's something that I've been on top of, and we've seen a really big rally in stocks on the back of that. Again, back in October, we had the small caps holding up. Now, I will be paying attention to these historic levels for rejections. I think that might be an environment where we might see some digestion of gains, but we've got the Dow potentially breaking out. Now, it has been outperforming the S&P 500, as I'm sure most of us know. We've got tech reclaiming the 200-week moving average. Last weekend, to our clients, I put the likelihood of an oversold bounce in a lot of the mega cap tech names. Again, the likes of Amazon, Google, Apple, etc. have all ripped this week, despite the relative underperformance in the breakdown. So that's something to bear in mind, is if we start to see big moves in the mega cap tech space, given the weightings that they have within the major averages, then again, that might be in an environment where stocks continue to thrive. We've got the micro caps again holding on to key levels, but I have added in here a 40-week simple moving average, which is very, very similar to the 200-day simple moving average. But if we can get a breakout above here again, that's a chart that would tell me that it's a more risk-on environment. And we've got the copper gold ratio breaking out as well, which again tells me a little bit more risk on. Now, that is of course the broader market covered. I hope I've done a good job. If anybody wants to ask any questions in the comments, etc., I tend to allocate 5 minutes, 10 minutes a day just dealing with social media, etc. So feel free to put up in the comments what your thoughts are, etc. If you have any questions or want anything expanded on. But I do have around 15 individual names here, maybe 20 actually, that I think you can maybe add to your watch list. There's some charts here that I have already posted to social media this week. Many of you are asking for targets, so let me just do my best here. But Netflix, of course, for me, I've had this chart for a while with an upside objective around 330. Now, for me, what we've seen here is very, very straightforward. It's a breakout, pull back to retest the breakout level, and we filled the gap. So for those of you that are asking, my target there on Netflix is around 330. The optimal entry is of course down here, maybe chasing a little bit but buying up here, but 330 is the level. Big oversold bounce in Amazon this week. I'm sure there's many that are happy about it. For me, this is a Fibonacci chart. Now, whether you buy into Fibonacci and its miraculous wonders like I do, it doesn't really matter. I think you can just look at it as basic support and resistance. If you look at something like Amazon here, it did break down below key levels. We've seen exactly the same thing with Google as well. So for me, if we want to see the S&P 500, if we want to see tech start to make bigger strides, you probably want to be in the camp that Amazon and Google reclaim these key levels. I think if those two stocks, of course we could look at Apple as well, which for me is just hovering around, doing a whole lot of nothing at the moment. It is at the lower end of its range. I like stocks that are at the lower end of the range because it's very easy to define risk. There is a very clear risk to reward proposition. So for me, Apple, my chart really hasn't changed over the last few months on this one. If you're buying at the bottom of the range, I think top of the range if it continues to chop sideways. Again, made a big bottom call on the semiconductors back on the 14th of October. Now, with that, I get asked a lot of questions about stocks like Nvidia. So let me just go over some of the stocks that I find appealing within this particular sector. Now, if we just zoom out here, I think this chart shows it very, very well. I think Nvidia is currently breaking out at the moment after putting in a bit of an oops, which, as I would hope most of you know, is basically a failed breakdown or bear trap, whatever you want to call it. And of course, it's been ripping higher ever since. So we'll see how far Nvidia wants to go. I think, let me just bring that back. I think with something like Nvidia, given the strength of the move that it has already had, I think we can probably expect some kind of pullback in the short term on this one. But for me, I'm in the camp that many stocks have already bottomed, and I think Nvidia could potentially be one of those stocks as well. KLA Corp, again, highlighted this one last month, bounced off its 200-week simple moving average. Now, this is an indicator that just tells me if it's outperforming the S&P 500. I'm always looking for stocks for outperformance. So if you like the semiconductor space, KLA Corp is one of those stocks that is outperforming the benchmark. ExxonMobil, again, just for disclosure, this has been recommended to our clients already. It's doing very, very well. Probably one of those value names that you want to pay attention to within the energy space, breaking out to new all-time highs. I don't mind that. I like blue skies ahead, so I think something like Exxon might make a lot of sense. Now, I got asked quite a lot of questions during the week on Tesla, because last week I posted a chart, or actually it was at the start of this week, I posted a chart just highlighting that Tesla's breaking down, but it's one of those stocks that I wouldn't want to bet against, because I do like Elon Musk and what he's doing for the world. Now, Tesla since then, of course, fallen off a cliff. But if we go back to some of the examples of failed breakdowns and getting fast moves going in the opposite direction, that's something that I'd very much want to see with Tesla. And for that thesis to start, for me, Tesla has to get above 210. In the same way, of course, Nvidia got back up above that 120 level. I'd want to see the same kind of response from Tesla. Going back to the energy space, ConocoPhillips might make a lot of sense for many of you. Marine shipping, believe it or not, there are plenty of areas within the market that you can navigate. It doesn't always have to be growth tech, etc. This ASC, we recommended this one to our clients way back here. It's been on a nice structural uptrend since then, performing very, very well. We'll see how that one develops. SPG, again, it met our upside objective this week, but it has broken out again. So again, I think if you like to manage risk, I think you can use things, and especially a chart like this, the 200-day simple moving average. It might make a lot of sense, but it did meet our upside objective there, 25%. Denny's Corp, again, very, very close to meeting our upside objective. Nothing uncomplicated about it. I like low PE ratios, and I like solid 12 months earnings growth. The food at Denny's is, of course, crap, but for me, the stock is doing as it should, and it's approaching our upside objective here. Copper miners, now, again, lots of attention this week, because last week in my weekly letter, I put out a chart for the copper miners, just highlighting that we were building a base, and for the expectation, at least from my end, is that we would get some kind of high momentum move within the copper miners. Now, that's exactly what we've got. We've had breakaway gaps in Southern Copper Corporation, and of course we've got a breakaway gap within Freeport-McMoRan as well. So I think if we get a pullback within these stocks, I think the pullbacks can probably get bought, but be aware that, of course, upside objectives here, hopefully they will eventually get met, but you'd probably expect at this point for these gaps to get filled. But again, that's why I like to use tools to incorporate risk management process that can absorb quite a lot of intraday noise and volatility. United Health Group met resistance this week. I was actually looking for this for a breakout, but ultimately it hasn't panned out. ELF, now this was put to our clients on the 18th of October, and it looks to be pulling back. The message to our clients last week was, look, the $50 round number is a very real psychological level. If we start to break below these levels, I think it's a good idea to perhaps consider taking profits. As I record this with just, I think, an hour left in the markets, we're starting to see this start to fall away a little bit. So if you are holding ELF and it's a trade and not a long-term investment, I think at least applying some kind of risk management process might make a lot of sense. Halliburton, again, performing very, very well. China, this is one of the charts from our ETF chart book. It's, of course, we had a capitulation early in the year. I think we had another one, and of course we are seeing another massive rally in China. For me personally, China is uninvestable. I don't like the noise, the volatility, etc. that accompanies it, especially the headline risk, the news. There's nothing about China that's appealing, but many of our clients are of course, invested in many areas all across the world, and the Chinese internet ETF KWeb is appealing to many of them. So the chart would probably have an upside objective here around $33. Micron Technology broken out this week. We are looking at this as a target level of 66, but if we can get above that $66 level, then I think Micron Technology might be one of those semiconductors that gets incredibly appealing. The reason for that, again, low PE ratios, solid 12-month earnings growth. And we've also got Penn, for those of you that like the growth tech aspect of it. It has broken out this week from a descending trend line. We've got a bullish divergence. So for me, it's just a waiting game. For me, I'd be looking at this as a double bottom breakout all day long. And I think if it can get above that, $39, $40 level, I think Penn might be one of those names where you could get a high momentum move. It wouldn't be a long-term investment for me. It would definitely be a trade. But for those of you that ask me about Penn and my thoughts, those are my current thoughts. So I hope you've had a lot of value from that. If you are maybe wondering who I am, what it is I do, and why you're watching me, feel free to jump on our website at honeystocks.com. We provide charting research to professional and retail client base every single week. We provide our premium work to our clients. Just to put you in the picture, this weekend I have around 10 individual names that look good to go for next week that I haven't communicated within obviously my social media work. We provide high conviction investment ideas. I provide a midweek halftime report, provide access to a wonderful community, provide access to my chart books, which covers stocks, ETFs and commodities. And if you're somebody that is maybe just looking to learn about technical analysis and maybe building a process, I include it completely free with all of our memberships, full access to our complete technical program, which I'm told is very, very good. But just to show you what our high conviction ideas look like, this is of course ExxonMobil. We put out ELF, again we put out ConocoPhillips, again another solid performer, Netflix, solid performer, and of course can be flexible, long or short. The commodity index was a big winner to the short side earlier on this year. But I am very, very unique in what I do. I log and timestamp absolutely everything. I think it's the most important thing for any professional research charting platform. So feel free to go and have a look. I also have a link here for all of our big time-stamped market calls, from our weekly letters, from our professional analysis. But I log every single high conviction idea that's ever gone out to our clients, and I've done that over the last 5 years. So again, feel free to go and check that out. But big announcement is I'm looking to take on 2 new professional clients. So initially to work with firm, money manager. If you are an accredited investor, then I'm looking to work with somebody over a period of 8 weeks with a view to a longer term working relationship. I haven't taken on any clients for the last 3 years because I've just been so busy, but I have recently taken on somebody to take care of all my admin, which has freed up quite a lot of time for me. So feel free to reach out if you are in that camp and you have a solid capital foundation behind you. Then feel free to check that out. But if you have stuck around to the end, thank you very, very much for watching, and let me know in the comments what you think. Thanks.